Get rich in 2023, the big themes to play. The world's growth engine, China, is reopening. This will drive energy and metal costs higher, but overall drops labor market and production inflation. You want to invest in natural gas and oil as a key portfolio hedge. The Fed is on the verge of a pause, which will send bonds, tech stocks, and digital currencies like BTC and ETHE skyrocketing. The next year will be marked with falling CPI prints, lower interest rates, and higher valuations in risk assets. Buy these 5 stocks now to get rich. Our safe growth portfolio has a total return of 154% since 2019. Outperforming the S&P 500's 53% return by 290%. Here's a look at our safe growth portfolio currently. Right now, per unit of investment, and again, if you're a member, you can log in and type in how much you want to invest, and it'll automatically calculate your shares. We have 8 shares of UVXY, the crash insurance play, which is coming in at just under 5% of the portfolio. We have a massive bond position with 57 shares of TMF, the 3 times treasury product. We're betting the long end of the bond market's interest rates are going to fall. That's on our defensive side of the portfolio. On the offense, we have the S&P 500 leverage times 3 with ticker UPRO coming in at 2 shares per unit, approximately 6.5% of the portfolio. We've been betting big on Asia, and it's finally paying off. With emerging markets ETF EEM, leverage times 3, we have 6 shares of EDC. Again, that's the EEM ETF times 3. We've got 11 shares of GBTC. This is coming in at 9.5% portfolio, or about half of our EDC position, which is at 20. We've got 4 shares of the leveraged NASDAQ play, the triple Q, coming in at just shy of 7% of the portfolio. And we currently have a small hedge in energy with 7 shares of BOIL. That's betting on the price of US natural gas going up, which is likely to happen because we have a massive cold front developing in the Arctic that's going to spread the globe, just as Europe's going to turn on its industrial output and China's going to go full bore. So we're looking for a big gain in that. Trade alerts coming to this likely on Friday. Make sure you upgrade to get it. But we're going to be getting out of GBTC. We're going to be going long NRGU most likely as the quick flip to the portfolio. We may also shut off a little bit of TMF and add some extra exposure to some special assets, which I'll reveal on Friday. Again, this is our safe growth portfolio, and we recommend you put 70% of your account into this portfolio. You can see our month-by-month breakdown. 2019, a 25% return. 2020, we played it safe. That was a crazy year. We're happy with the 4% return. 2021, we had a 25% return. 2022, we underperformed. We gave back last year's return, but that's because we were running 3 times leverage. So we still kept up with the S&P 500 using 3 times leverage, and now we're up 9.8% in January. This portfolio is getting ready to explode and probably have its best return in its history. Our high risk portfolio, which started 2 years later, is up 197% total return. This is outperforming the S&P 500 over the same period of time. It only returned 7%. We're outperforming by 2,681%. We're recommending investors put 30% of their portfolio behind this strategy, as again, it's much more high risk. Per unit of investment, and again, if you log in the membership area, you can punch in how much money you totally want to invest. We're buying 20 shares of UVXY, the crash insurance hedge, 7.7% allocation currently. We're putting in 49 shares of TMF. That's the long bond, betting interest rates are going to fall because inflation's falling for the next probably 2.5 years. And we do think there could be some bounces in inflation, but overall the trend will be deflation. That's our defensive side. On the offensive side, we're in Coinbase, ticker COIN. It's the last standing exchange that's not corrupt, and it has massive, massive upside due to call options, big funds like ARK funds loading up into it. And now it's the better alternative to GBTC and ETHE, which was hogging up a lot of the capital. People are going to get out of that and go into real companies. We then have 8 shares of FNGU. This is 10 gigantic tech companies that get massive call options from retail investors. When you get the right signal, these can melt up, and we're looking for this to have an astronomical return this year. This is coming in at 8 shares and 24.9% of the portfolio. Our coin positions at 24.6, our treasuries at 27, and our UVXY is at 7. Currently, we have twice the hedge against energy in this portfolio, with Boyle betting natural gas is going to go back up, again, due to China reopening, Europe turning on its industrial engine, and a cold front about to come through. So we think we'll be pulling a nice profit on Boyle around March. That one we've gotten caught off guard by being a little too early, but remember, it's the third time we're pulling big profits out of Boyle if I pull this off. Last year we hit triple digit returns twice in that ticker. Trade alert coming this Friday. Likely we're going to trim down the treasuries and add to NRGU as a potential trade alert for the high risk. We'll see if we want to add to Boyle or diversify slightly. This portfolio began in December of 2020 and returned 4% that month. In 2021, it returned 233%. A lot of that happened in only 2 months. So January, we had 127% return, April, a 28, October, a 33. So 3 of the months really delivered the bulk of the gains. And again, we're expecting some monster gains to occur in 2023 with very few changes. 2022, we're up as much as 50% with a huge gain in July of 31. We gave it back this winter, primarily to a bond market energy crash, which was due to essentially the Fed trying to scare the crap out of the markets, but we're still holding to our guns. We believe the Fed is going to be forced to pause by the bond market and the CPI prints as the rest of the world is going back online. So expect some monster gains ahead in this portfolio as well. So here's what the big news is tomorrow. The CPI is expected to fall, and it's supposed to fall a lot. So one of the key headlines is 6.6 on the main CPI, and we'll see how that plays out. So it dropped from 7.1 to 6.6 on the main consumer price index. And then when we exclude food and energy, we're expecting it to drop from 6 to 5.7. As long as that comes in line with estimates, expect a nice rally in markets tomorrow. Now, if it comes in below, expect a monster rally. So why are we so confident that we have lower CPI prints? Well, let's look at some leading indicators. The producer price index has been leading in front running the CPI, and it's falling much more rapidly than the CPI is currently. In the dark blue line, you can see this relative to the light blue. Another driver of inflation is the increase of the money supply. Since 2021, there's been no money supply. We've not created new money in the US to fight inflation. And this is predicting we're going to fall until the end of 2022 and into 2023, just based on the M2 money growth. Now, they may have to turn that back up, which will probably bottom out the CPI and PPI sooner than where that's bottoming out. Now, if the Fed were to pause, what's the typical return? There's one time in 2000 where it continued to crash. However, all the other examples, we had a huge gain coming up. In 84 to 87, when the Fed paused, we had 104% gain in the S&P 500. In 88 to 90, a 39% return. In 94 to 98, 166% return. From 2000 to 2000, over a 3-month period, you got 11% return, but it wasn't the bottom of the dot-com crash, and they had to keep hiking because inflation wasn't going away. 2006, 2007, we got a 28% gain, again, leading into the financial crisis. We'll talk about how to predict a real crash and recession. And then from 2018 to 2020, when they paused, you got a 44% gain. So good statistics. Now, another thing is that the personal savings rate has gone negative for the last 2 years. So savings are being depleted. I want to be clear, though, the amount of savings that were collected during the lockdowns of 2020 with all the free government money was extraordinary. And we still haven't dried all that up. So there's still a lot of dry powder in bank accounts. Credit remains strong. People are paying their debt. We're not seeing some sort of growth slowdown anytime soon or a reason to get worried for a stock crash. Now, the Fed is using some ridiculous data to show rent inflation. If we look at the Fed's rent by CPI in black and then compare it to everyone else, such as Zillow and a bunch of other websites that have more real-time data, the rent deflation is crashing. In fact, in December, we had the biggest crash in rent prices in the last decade. So we know for sure this part of the inflation picture, which is 35%, the shelter in place, is set to fall for the remainder of the year. Another concern of the Fed is wages. If we look at job openings relative to wages, job openings are already starting to fall. So we expect wages to also fall. Now, this is the number of consecutive months of stronger than expected payrolls. Imagine you're playing roulette and you bet red over and over and over again, and you won 10 times in a row. That's what we've seen in this economy. It won't be long until we're having a reversal where expected payrolls are disappointing and the market's going to absolutely love it because the Fed's going to start to get closer and closer to easing monetary policy. Here's a look at those wages. We can see the wages have been rising, and this is due to a shrinkage of the labor force. Now, a lot of people want to say we're in the 70s like inflation that's going to be uncontrollable, but I want to point out that the labor force was much greater and rising over that entire decade. What's the trend in the US for the last 20 years since we've outsourced manufacturing and hollowed out America? Well, we've had less and less people participating because the jobs just aren't that great. And with the lockdowns, a lot of people, about 3 million people, just don't want to come back to work. So we don't have this huge increase of labor making more and more money to drive this long-term inflation like the 70s. I'm sorry, it's just not there. And when we compare the wage increases to the level of inflation, we can see real average weekly earnings are negative. So even though people are getting a wage increase, they're making less than their increase of cost of living. So they're buying less and less stuff. Sorry to spoil it for you, but that's also deflationary. If we look at energy inflation, it's set to dramatically drop as we've now really reacted to the sanctions on Russia. And again, they're not really working, but everybody has figured out new solutions to get their energy. And we have oil and gas down significantly from the high of February when we saw oil spike to 130. Now, don't get me wrong, I do expect oil and gas to go back up. This is the single part of the inflation picture that I do think will be sticky for the next decade. And this is due to malinvestment. We've put trillions of dollars into wind and solar, and they just don't do the job. What we haven't done is invested in gas and oil. So there's going to be a huge supply shortage. And we believe this is an important hedge to buy the dips and sell the rips over the next decade to protect your long duration plays, which will be in tech, digital currencies, and bonds. Used cars are in straight up deflation. We had the biggest drop of 19% in December. So used cars are crashing. This was a huge part of the CPI that was pushing it up over the last year. So all our leading indicators are very good for what we're anticipating. US freight rates versus goods inflation is crashing. You can see it's way below on the Shanghai compared to the PCE goods inflation. The UN food price index is also falling, far below what the CPI is currently printing. So they're using old data to try to keep this dialogue up of being super hawkish until they're really sure they've killed the inflation, because they got it totally wrong. They're saying inflation was transitory. Now they're saying it's never going to go away. So these guys are constantly wrong. And the first thing to get in this game is to not trust what they tell you verbatim. This is looking at the yield curve relative to bank loans year-over-year growth. And it's important. What we're really worried about to predict a recession is the yield curve inverting. So that means we want the front end to crash, and then perhaps the long end is coming down slower. That would make the yield curve invert. The period where the yield curve stops being inverted and starts to tighten is typically a very bullish setup until it eventually slows down the economy as long interest rates become detrimental to growth. So we're just not there. We're in the Goldilocks period before a recession currently, where interest rates are going to fall across the curve, and we're going to likely see that reverse course on the red line. Also, again, massive bank loan growth. So the economy is strong. Here's a look at how much bank loans we've done in 2022 compared to 2021, 19, and 18. It's just massive, massive, massive. Now in 2020, they didn't do any loans because the government was giving out free money. Car dealership guy says used car prices fell 14.9% year over year in December, by far the largest decline ever recorded. Here's another chart. Again, this is one of the reasons why the Fed's still talking super hawkish despite the obvious deflation coming in. The single most important problem of big businesses is currently pointing directly at inflation. But again, we believe that's going to fall, and growth is going to become the new important topic. What about compensation of small businesses? The black line is the actual, the gray is planned. We see the actual compensation is falling. If we look at employment versus planned employment, job openings versus planned openings, both are falling. This is the trend we want to see. Now it's still growing, but it's growing at a much slower pace as these fall. What about prices paid actual versus planned? Well, we can see both are also in a clear downtrend at elevated levels, but falling. What about sales? The expected sales have been very negative compared to actual sales. And we're seeing a sharp revision in expected sales as people are realizing that things aren't as bad as they thought, and everything's getting normalized currently. Same thing with earnings. No big crash in earnings. This is looking at ISM prices paid in the services sector relative to the services inflation CPI. And you can see ISM prices paid has crashed massively compared to what we're printing on services inflation, which is really where the sticky part is currently. The rent, which we know is going to fall, shelter in place, the services and the wage gains are where the sticky inflation remains, but all indicators show this is going to begin to fall once again. In Europe, the inflation is peaked. PPI is crashing faster than the CPI, same as the US. Europe's done a good job at filling up its gas tanks to fight the Russians through winter. Now, this could become a problem when the European industrial sector really turns on. They had to shut down and really make people not use much energy to get in this strong position they're in. But they can't hold that up forever without crushing their economy and pissing off the populace. So expect energy inflation, again, to be probably one of the better investments back and forth to buy the dips, sell the rips over this next decade due to malinvestment. Okay, food pricing, again, a new chart showing the same thing. UN food price versus what these central banks are printing is far different. And so again, another chart looking at gains over various periods of time when the Fed pauses, and almost always you get this big return during the pause. Now, pivots typically are when they drop interest rates into a stock crash. We're not wanting a pivot, we're wanting a pause. Here's a look at the various lengths of bear markets. So this one's at -25 with 1 year. The pandemic caught a lot of people off guard, including myself. It was only 0.1 year with a 34% decline in about a month and a half. And then again, they printed trillions of dollars. And then we can see all these other periods of time. They're very, there's a huge variety of different durations of bear markets. But our signal is pointing to a nice return this year to be long stocks. Now, Boyle has had some trouble, and it's mainly due to warm temperatures across the globe. And we can see in this chart, we're having far hotter temperatures than usual. And this has actually led Europe to increase its inventory. We're buying oil when they fill all the way up, and we're selling it when they get to low levels, predicting relative lower to higher prices. And so the good news is we have this massive polar air in North America with negative 40 degrees Celsius temperatures. And this is accumulating and is likely going to start spreading. So we're actually looking for the cold weather to hit late in January, just as China and Europe are likely going to need to reboot their economies and start using this key commodity. Another interesting fact, ETH is going to do the Shanghai upgrade in March. This allows people to get in and out of staking ETHE. Previously, you had to stake it and you never knew when you could get out. And this led them to only having 14% staked. DOT has 46%, AVAX has 62%, Sol has 68%, Cardano 72%, and the Binance coin has 90%. Imagine if 90% of ETH were locked up to collect a really nice yield that outperforms T-bills and has 10 times growth potential. We're extremely excited for this asset class. Okay, urgent trade alert in your email. If you're on a free trial, you're getting a $50,000 sample trade alert in our high risk portfolio because we want you to make more money during your trial than the service costs. So right now, to follow the high risk portfolio with 50,000, you'd be buying 638 shares of UVXY, 1,564 shares of TMF, 287 shares of Coin, 255 shares of FNGU, and 670 shares of BOIL. Let's look at some key economic data. Consumer spending still at all-time highs, no signs of weakness here. United States balance of trade has dropped. That's good for predicting lower inflation. You can see during higher levels of inflation, Americans were importing goods at record pace. That's mostly Amazon gone wild. US retail sales have slowed down from really hot prints at 2.7, 1.7 to having a negative 0.6 print in the last month. Consumer credit's growing at a clear $20 to $30 billion a month. It's slowing down, but steady growth. And again, delinquencies are at all-time lows. Nobody's not paying their credit card debt. Banks are growing credit, and this is a great trend for growth. China's PMI is coming back online, still below 50. Probably a good time to sell our energy will be when the Chinese hit another 55 PMI print, meaning they're going to probably slow down everything to try to get their energy costs back down. If we look at the health of the growth engine of the world, China exports are still at nearly 300 billion in the last print. Chinese imports are still healthy at 226 billion. So there's no reason to think we're about to have some sort of economic collapse. Call Dean now to upgrade your free trial at 505-322-7515. Okay, let's go through each position one by one. We're looking at Coin up 25% in the last 5 days. It's down 39% in the last 3 months, and it's down 81% over the past year. Its valuation today is the same as its IPO almost, and now it has 10 times the user growth. So it's a killer buy and our favorite way to play digital currencies in the stock market. Now, if you're a paid member, you can gain access to Rebel dividends. We're going to give you a leveraged ETH play plus the top apps, and that's going to smoke Coin all day. But let's look at the underlying digital currency that we think will overtake the market cap of Bitcoin, maybe this year, definitely in the next 5 years, and the single best investment that you can make this decade. ETHE is up 4.5% in the last 5 days. Rebel Dividends is up 25% to put things in perspective. It's up 3.6% in the last 3 months. Bitcoin's down 20. Over the last year, it's down 60%. And if you go back to 5 years, it's up an incredible 15,000%. Now we're getting out of the Grayscale Trust, ETHE, and GBTC. This is a huge lawsuit between Gemini, Genesis, Digital Currency Group, and the Grayscale Trust. And we just want to get out of the way. There's no reason for us to take that risk when there's alternatives. Now, the key reason to be long digital currencies is you bet governments globally are going to spend more than they make. And this year, the major governments are planning to sell $6 trillion worth of debt. This shows you the growth of debt since the 70s. very, very, very infrequently do they reduce the total debt. And we just got through a period of keeping things tight, expect a period of spending loose ahead. And again, the deflation's the key for them to get away with it. Here's the US government's federal budget deficits. Again, we're expecting a 1 trillion deficit per year, growing to 2.3 trillion by 2032. There's really no way out of it. Based on bond market cycles and the Bitcoin halving cycle, we're expecting to hit a new top in digital currencies around 2025, with BTC potentially hitting 200,000, and perhaps you see ETH hitting 20,000. Now, again, call Dean to upgrade your free trial to get our trade alert on Friday at 505-322-7515. Commodities. Let's check out Boyle. This one's been killing us. We've made a lot of money last year, twice, with triple-digit returns, and I believe we're going to do it again. We got in a little early, so the warm weather plus the European price caps caught us off guard. But what this is all adding up to is going to be a supply shortage. With Europe's price caps in place, they're going to get less supply. As Europe and China reopen and a cold front hits, this thing is ready to explode to the upside. So down 78% in the last 3 months by the dip on Boyle. You can see those last two run-ups we got in February, got out in early June. We got back in before the August run-up, and then we've been buying into this crash over the last month. So not the perfect timing on this one like we did the last two. Again, the warm weather got us and the European price cap, but this is all going to build up pressure for a big, big shoot up in Boyle. And we also like NRGU, but we're looking for a good timing to get into it. Last 5 days, it's up 10%. Over the last 3 months, it's up 13%. And over the last year, it's up 88%. So we potentially have a good entry point very soon, maybe this Friday. We'll pull the trigger. And this is going to give you a leverage play in Conoco, Chevron, Devon, EOG, Marathon, Occidental, Phillips, Pioneer, Valero, and Exxon. And as you know, Buffett's huge in Occidental. Now, again, the Boyle's betting on the spot price of natural gas in the US to go up, while NRG is a leveraged play on the profitability of these major oil and gas companies, which have special deals. They're not letting anybody else get into this sector. So these are the ones to play. Here's a look at Boyle, up 5% in the last 5 days, oil, but it's down 10% in the last 3 months. And we believe this is setting up for a really good buying opportunity. Now, Exxon's priced to perfection at 110. This is an all-time high price almost, and it's likely going to go even higher because there's just not enough energy in the world to fuel the world when everything goes back online. Look at that beautiful chart on Exxon. Crash insurance. UVXY has not done a great job this year because we haven't had a sharp decline in a short period of time. This is really what's going to make a lot of money if there's a black swan event that causes the market to fall super, super low. So if the inflation is way worse than everybody's anticipating, if central banks ignore the data and keep tightening, or we launch some nukes in Europe, are 3 key reasons you should have some insurance in your portfolio. It's down 55% in the last 3 months. It's down 50% in the last year. But here's what it did in 2020 in March when the whole world locked down and caught everyone off guard. It went up 1,000%. So a 10% position doubled your whole account if the other 90% went to zero. A huge benefit. This is the analog to 2008, assuming we're going to have another rally, inflation catches everybody off guard, and then the Fed crashes this thing on purpose. So we've got that just in case. I don't think that's the base case. Bonds, if you think inflation's falling, interest rates will fall, and bonds are going to be a safe way to make a lot of money. We like the leveraged product on the 20-year Treasury with TMF. It's up 5% in the last 5 days. It's up 10% in the last 3 months. It's down 64% in the past year. This is a killer deal to get into it. Now, the underlying asset that's similar to it is the TLT. We're leveraged into the TLT times 3 with TMF. And in the last 5 days, it's up 2%. In the last 3 months, it's up 5%. In the past year, it's down 26%. If we look at other bond markets, the investment grade bond market, we're not in right now, but we're looking at the health of all these bond markets that fuel stocks. LQD is up 2.4% in the last 5 days. It's up 7.8% in the last 3 months. However, it was down 15% in the past year. The junk bonds are up 2% in the last 5 days. They're up 6% in the last 3 months, and they're only down 11% in the past year. So the high risk stuff's getting the bid in front running assets like ETH and the junk bond market. Now, if we believe the bond market's in control and the Fed will do what it says, let's see what we're seeing in the current data. Are they really going to hike rates to 5% or 6% like some of these crazy Fed speakers have said in the last few weeks? Well, the bond market says BS. The 3-month has topped out over the last 5 days at 4.7. It's currently at an all-time high in the last 3 months, and as well as the last 1 year. The 2-year bond, however, and again, this could very well be the exact terminal rate. The 2-year is saying, no, it's going to be less than that. It's currently priced in at 4.2, which is very close to where we're at currently with the federal funds rate. It peaked out 5 days ago at 4.4, and its all-time high in the last 3 months was 4.7. So as we can see, it's really topped out and is not predicting the Fed will be able to get up to 5 or anywhere near it. I'm expecting they'll do a 25 basis point hike in February and March, and then that's it. And perhaps even stop in February, depending on how fast the CPI is falling. The 10-year is already saying that they're going to have to cut rates into the future. And it's trading at 3.6 and topped out at 3.7 over 5 days. 3 months ago is topped out at 4.2, and now the interest rates have fallen 9%. And if we look at a bigger picture, we can see it rose up to October and it's been falling ever since. The 30-year has been in a decline over the last 5 days of 2.7%, dropping interest rates lower. It's been falling for the last 3 months, dropping 5.6%. And again, we can see it also topped out in October. So the bond markets all believe the Fed's just about done. The Italian bond is showing a similar trend. We're seeing really bad inflation out of Italy and Germany, with them unable to maintain their deficits in their bond market. And this was one of the leading indicators of problems in the bond market. Over the last 5 days, the Italian 30-year is down 5% in terms of interest rates falling. It's down 9% in the last 3 months, and we can see it topped out back in October as well. Lumber futures getting a little bit of a bid in the last 5 days. Remember, this was leading to insane housing prices. But over the last 3 months, it's down 12%. Over the last year, it's down 68%. Copper futures are up 11% in the last 5 days on the China reopening. This could be a new hedge we might add to one of our portfolios, probably safe growth, because China uses tons of copper. It's up 20% in the last 3 months. It's down 5% in the past year. And this is one of the metals we like to use as a hedge to inflation over the next several years. If we look at the Baltic Dry Index, the cost of shipping commodities between continents, it's down 37% in the last year and much more since May. Here's a look at it. We saw it peak out at 5,000, and again, it's at 1,096. So almost everything's showing falling prices. Wheat is down 1% in the last 5 days. It's down 17.9% in the last 3 months, flat in the past year. There's really no reason to think the CPI is going to stay at this level. Typically, when we get these big spikes in inflation, it turns around into massive deflation. So we're really seeing that inflation is a phenomenon that happens when the supply for a very short period of time is way under the demand. The second the demand supply problem is fixed, the inflation crashes like a rock. That's going to be very good for the way we're positioned. Sentiment was at a very low price in May and has been recovering ever since. So this is the University of Michigan Consumer Sentiment. Whenever it gets to this low of a reading, it's typically a really good time to be buying stocks. Initial claims we'd like to see rising. Again, a lot of people quit the labor force, so I'm not so sure we're going to see a big unemployment rate spike. Here's the inverted yield curve. Again, this is typically a good time to go long bonds. And it typically happens when the Fed's fighting inflation by jacking up the front end of the bond market, which is what we're currently experiencing. It's when this starts to steepen and get back to those 2 levels that we want to get out. And this is typically what leads into crashes seen in the dot-com and the 2008 crash. This period where it rises and the yield curve steepens is typically very good for markets. Okay, we're not in the dollar, but we'll look at some currency charts. We were last year because we thought the Fed was going to be tightening. Now we don't, so we don't want to be long the dollar. We think the dollar is going to fall, but DXY is flat over the last 5 days. It's down 8.75% in the last 3 months, and it peaked out in October, just where the inflation and bond market peaked out. So unless there's going to be a return of massive inflation out of nowhere, and the Fed's going to keep tightening because of it, we're really set to jet here with our current positioning. I'm going to skip through these other currencies as they're not super important right now. FNGU is the ultimate way in our high risk portfolio to get exposure to major tech giants that have leverage ×3. So FNGU is up 25% in the last 5 days. It's flat over the last 3 months. It's down 85% in the past year. You're still super early to get into FNGU. You can make 10 times your money on this, holding it to about 2025 by our estimate. The S&P 500 is up 3.6% in the past 5 days. It's up 9.9% in the last 3 months, and it's only down 15% over the last year. It looks like we've had a double bottom and getting ready to rebound. NASDAQ's up 5% over 5 days, 5% over 3 months, 27% to the downside over the last year. And again, we believe this is bottoming out, getting ready for a very vicious rally. Emerging markets, which we have in our safe growth portfolio, leverage ×3, is up 4% in the last 5 days, but it's outperforming everybody in the last 3 months on the China reopening, up 17.8%. Emerging markets were getting killed for the last year and a half due to the inflation and the Fed hiking, but that's over, and that's why EM's set to likely outperform this next cycle, which again, I think will top out around 2025, down 18% the past year. This chart compares emerging markets to US markets. The purple is where emerging markets outperform. It's usually for a shorter duration, but that's exactly what we're predicting, isn't it? A nice little run up to 2025 where emerging markets are going to outperform due to interest rates falling and the dollar index falling, with foreign currencies and digital currencies getting the bid. Is there a big collapse and contagion out of Europe? Doesn't look like it. The European index EFA is up 3.7 in the last 5 days, 23% in the last 3 months, and it's only down 12% in the past year, outperforming US markets now. Some other assets we're looking at getting into long-term are uranium for nuclear power, 9% return in the last 5 days, 11% over the last 3 months, and only down 5% now over the past year. Rare earth metals. So it's going to give you lithium, cobalt, things that companies like Apple really need, up 10% in the last year. Another China play. So we have this pretty well set with EEM. But if we want to be more strategic to protect our inflation in electronics, RMX makes a lot of sense. Now, over the past 3 months, it's up 3.5%. Over the past year, it's down 25%. This could be a potential trade alert in the future as well. Amazon's up 12% in the last 5 days. It's down 16% in the last 3 months, and it's down 41% over the past year. This is a company inside FNGU that you get leverage ×3. Apple's up 5% in 5 days. It's down 4.3 in the last 3 months, and it's down 23% in the past year. Again, you get exposure to this with both triple Q in the safe growth and FNGU in the high risk in size. Alibaba is inside of emerging markets, up 10% in the last 5 days, up 51% in the last 3 months. Huge return, and down only now 13% in the past year. Baidu's up 5.6, 27% return in 3 months, and now only down 10% over the last year. Facebook, Meta, is up 6.3% in the last 5 days. It's 4% up in the last 3 months, but it's been creamed, down 59% over the past year. So we'll see if he can turn this company around. Google up 5% in the last 5 days, down 6% in the last 3 months, down 34% in the past year. Again, you get leverage into Google with FNGU. You're buying it at a great discount. Microsoft getting ready to go big on AI for the next decade, and perhaps invest in ChatGPT, which is going crazy. 4.6% return in 5 days, 4% return in 3 months, down 24% the past year. Again, we say buy the dip with leverage with FNGU. Netflix up 4.6, 51% in the last 3 months. So these companies are getting beat up the most, are having the best returns right now. And again, it's still down 38% in the past year. You're not too late. FNGU gives Netflix times 3. NVIDIA really kicking butt, up 12% in 5 days, 37% in 3 months, but it's still down 41% over the past year. It's not too late. You get this with FNGU. Tesla up 12% in the last 5 days, down 43% in the last 3 months, and down 65% in the past year. Okay, so this again is in FNGU times 3. Let's look at the banks. They're up 4% in the last 5 days with JP Morgan. 36% return in the last 3 months. This is with interest rates falling and down only 11% in the last year. Bank of America, 1% gain in 5 days, 4.5% in 3 months, and down 28% in the last year. So with UPRO, you get exposure to JP Morgan and back in our safe growth portfolio. With emerging markets, some other big companies are Taiwan Semiconductors, up 6.7% in the last 5 days, 27% in the last 3 months, but you're still getting it cheap, down 42% in the past year. EDC is your ticker for that in our safe growth portfolio. Tencent, the big software company out of China, is up 9% in the last 5 days, 51% in the last 3 months, and still trading at a 20% discount over the last year. Samsung, up 5, also in EDC, up 5% in 5 days, 14% in 3 months, still at a discount, 22% down in the last year. Okay, so if you don't want to miss out our trade alert on Friday, call Dean now at 505-322-7515 to upgrade. We'll go ahead and take some questions, and then we'll get ready for the PPI print on Friday. So I hope everybody enjoyed the presentation. Got our 2 disclaimers up. Nice audience. Hopefully everybody's getting super excited for 2023. Okay, so tomorrow we probably won't do a trade alert. Maybe if it's a really low print, I'll probably rush out a trade alert and get you guys more aggressive in a couple trades. For Rebel dividends, if we see a low print, we're going to leverage right up into ETH. So you have a huge opportunity ahead of the next few Fed meetings. Okay, Aaron says, thank you. Bill says, nice presentation. So yeah, either a trade alert tomorrow or Friday for Portfolio Builder. And then if you're in Rebel, expect me to leverage the heck up, get that low CPI print tomorrow. If it's just in line or a little hot, we'll just stay course. Okay, very good, guys. So thank you so much. I think this presentation was the best one we've had yet, and we're going to keep improving it next week. So thank you so much. If you have any questions, email me or call Dean. Again, if you have Coin, if you have Silvergate, SI, if you have mRNA, if you have MicroStrategy, if you have ETHE, you have GBTC, or you're holding GBTC, ETHE, RIP, XRP, any of those can be sent to Rebel Dividends and converted into shares that give you leveraged exposure into ETHE, into ETH, the real thing, plus all the software apps that are being developed on that blockchain. So we really recommend that to replace your GBTC, your coin, or any digital currency exposure. Let us manage that with leverage and give you a much more diversified portfolio. So thank you guys so much, and we'll see you back next week.